Thanks for the introduction, and welcome to all of you joining our webcast today. As Fraser mentioned, my name is Matthew King. I run Morgan Stanley's listed infrastructure practice within the Real Assets division of Morgan Stanley, which is the institutional investing division of Morgan Stanley. I think most of you on the webcast today will know Rod Smith. He's the Chief Financial Officer of American Tower, which, as Fraser mentioned, is the largest tower operator globally, listed tower operator globally, as well as the largest in the United States. So with that quick introduction, I think, I've got some questions prepared for Rod that we'll go through here. And then hopefully that will introduce some questions, and we'll see if there's any questions here in the audience. So I'll jump right in. And so I think where I wanted to start, Rod, is you've been very clear with the recent full year earnings call about the near term and medium term operational trends in the business, both on the positive side as well as some of the challenges with churn in some of the various markets. But for those on the call, or excuse me, on the webinar that haven't had a chance to listen to your annual earnings presentation, maybe just go through the operational trends here by region, starting with the U.S. And in particular, India has been a topical region in the recent past. Maybe just update us on India specifically, and where you think growth rates might normalize there. Thanks.
Sure. Thanks, Matt, for being here with me and agreeing to kind of host, and thanks to Fraser for hosting as well. So it's great to be here with you, and it's great to be here with the whole team. I think it's a great place to start. So let me recap to the audience kind of some of the highlights from our recent earnings call. First off, 2020 was a great year for us. We did have a global pandemic, which certainly had effects around the globe. One of the effects that we saw is that it really highlighted the critical nature of wireless networks, wireless communications globally, and in particular, just the critical nature of the infrastructure that those communication networks run on. And certainly that's towers. That we saw that in the US, and we saw it kind of around the globe. And certainly that helped us post really good numbers through 2020, despite the effects of the pandemic. So on an FX neutral basis, we posted double-digit growth rates across property revenue, adjusted EBITDA, and consolidated AFFO and consolidated AFFO per share for the full year of 2020. So really strong kind of financial performance there, again, despite the pandemic. We also closed on the Eaton acquisition in Africa at the end of 2019, and we were busy integrating those assets into our network in 2020, and that went fantastic. And in Africa, we actually posted organic growth rates that led our business, which were in the high single digits for organic growth rate, including those Eaton assets that were in there. We also built almost 5,900 sites around the globe, and we closed on the Insight transaction in the U.S., which was a U.S. tower company that we bought just at the tail end of 2020. And we are busy integrating that now into 2021 and working diligently to get those sites up and marketed in our systems and available to customers, and that's going exceptionally well. And we ended 2020 with significant momentum as we kind of headed into 2021 on a couple of different fronts. Most notably, we announced the pending acquisition now of the Telxius assets, which cover a significant number of sites throughout Europe, concentrated in Germany and Spain, and also across select markets in Latin America. So that'll be a transaction that we'll be working to close in a couple of tranches throughout 2021. When you move into 2021, there are a couple of things that we did. Certainly, we see a really good constructive backdrop, not just in the US, but around the globe, as we see the incremental monthly run rate new biz that we're adding to our run rate increasing and accelerating. So that growth rate is accelerating as we go into 2021. And we expect that to continue into 2020, 2022 and beyond. And it's really driven by a couple of noteworthy things. One is the growth in mobile data consumption in the US and around the globe. It continues to run at a pace that's in the 30 to 40% range. And that really is a very strong support for our business and for the carriers' continued investments in their networks. We're also seeing new deployments of spectrum, the C-band spectrum in the US. We expect that to begin to hit the cell sites towards the back half of 2021. And around the globe, we're seeing networks transition and build out 3G networks and transitioning into 4G networks in most of the developing markets that we're in. And in the US, the industry is very well positioned to see an acceleration of the 5G deployments now that we have the Sprint T-Mobile merger behind us as an industry, and the C-band spectrum has come out. I think we expect that transition to happen here pretty sharply in terms of beginning to see the carrier spend shift towards 5G, not in a dramatic way, but you'll see 4G spending and you'll also see 5G spending. And over the next few years, we think you'll see that spending shift increasing in terms of the percentage that is devoted to 5G. And that's a really constructive backdrop for us as we kind of move in into 2021 and beyond. And then in terms of, the other thing that we talked about, a couple of things. One is in the US, we did talk about a long-term organic tenant billings guidance. So we took guidance out from, 2021 out through 2027, and we're projecting on average a 4% organic tenant billings growth rate across that time period in the US. Now that includes the Sprint churn that we've talked about, and I think we may get into that a little bit later. I won't go through the details there. If you normalize for that Sprint churn, we expect that growth rate over that 21 to 27 time period to be up around 5%. So really strong, kind of solid single-digit organic growth rate over a long period of time, which we think is really exciting for us. A couple of the key drivers, I'll hit a couple of the key drivers there for you, Matt, and for everyone watching here. 2/3 of that organic growth rate in the US is contractual. It's already committed in contracts. And the other 1/3 is going to come from either normal deployments and normal carrier spend for carriers that aren't under long-term holistic deals. Some of it will come from the incremental activity that we may see from C-band deployments over the next several years. Again, C-band deployments that aren't covered under some holistic contractual obligations we have with some of the carriers. And new entrants could be upside, to that organic tenant billings growth. Most notably, maybe Dish. We do have some revenues in with the expectation of Dish building out, but I think there could be some upside there if Dish comes out really aggressive over the next several years. And then we have a modest amount in platform extensions. People have heard us talk about edge computing and in further penetration of in-building sites in a 5G network, some fiber connectivity, potentially bringing fiber to some of our sites to enhance the backhaul at certain sites based on capacity needs and that sort of thing. So for us, it's an exciting kind of outlook, a solid normalized 5% organic tenant billings growth with some meaningful kind of upside available there as well. On the international markets, we expect the international markets to continue to outpace the US when it comes to organic tenant billings growth. And that's kind of the accumulation of all of our investments in India, across Latin America and throughout Africa, and now in Europe as well. And the things that are driving that is we see an acceleration of the build outs going to 4G. We see that across India. We see that certainly in Latin America, and as well as Africa. The wireless carriers there are quickly transitioning from 3G networks for coverage to position themselves to invest and develop 4G networks. And we see that happening kind of across the board. And we do see that acceleration in incremental new business activity, not just in the US, but in a lot of these key markets that we have around the globe. We expect to build about 6,500 sites in 2021. A lot of those sites will be in the developing markets in Latin America, Africa, and primarily in India. And I would just remind everyone that that's the highest NOI yield that we see. They're the highest returning investments that we have. So we're really excited about our ability to continue to build sites at a high level. Again, in 2021, we built just under 6,000, just about 5,900, and we expect that number to go up. Certainly internationally, when you talk about thing that I would say really about the about the earnings call and kind of the outlook is we also reaffirmed our goal of driving double-digit AFFO per share growth over an extended time period. So we're projecting that between 21 and 27. Means that we may not hit that every year of the 7 years throughout this time period, but on average, we think we'll be in that right in that target. And we think that's a very achievable goal. I would point out, Matt, that 2022 may be the most challenging year for us in terms of trying to achieve that double-digit AFFO growth. And that's primarily because of the sprint churn that we have that begins to hit our run rate revenues in late 2021, and will have a bigger effect kind of portfolio will be minimal, beyond AFFO, consolidated AFFO per share growth over that long period of time, 21 to 27.
Okay, yeah, thanks. I got a little technical difficulty, so there was some freezing there for a couple of minutes. So hopefully I'm not repeating a piece of what you've already explained, but I wanted to touch on a couple of things that you mentioned specifically. I think, coming back to India and some of the challenges you've had there. As you said, you've provided now an outlook for 6 years through 2027. Can you indicate just directionally when you think within those 6 years you might see more normal growth rates within India? That's question number one. And then also on the international side, clearly there is a discussion, or there's a lot of discussion about inflation and what that means for the markets, financial markets here going forward. Given that some of your international tower assets have explicit ties to inflation in the lease structures, can you give us a sense as to how much of that top line organic billings growth, as well as the aspirational target for double-digit AFFO growth, translates from the inflationary aspects versus the more industrial or operational aspects of leasing in the build to suits that you did mention, I think it was 5,900 in 2021 going forward?
Yeah, absolutely. So hopefully the technical difficulties here may be behind us. I'll keep my fingers crossed. When you think about India, I guess there's a couple of things that I would highlight within India. First of all, India is really shaping up to be a fantastic market for us going forward. So as you point out, Matt, we have kind of gone through a period of rapid consolidation in India where, many carriers consolidated down to a few. We now have a backdrop in India where we have 3 primary commercial carriers in RGO, Airtel, and Voda Idea. And then with BSNL as making up the 4th kind of government-backed carrier. So the backdrop is much healthier for the long-term dynamics of that market. It's better positioned now than it's ever been. And we do see most of the churn resulting from that consolidation is now behind us. With that said, there still is a little bit of churn in that marketplace that we dealt with in 2020. There's more in 2021 that we're kind of working through. And a lot of that churn stems now from a couple of things going on in the market. And most notably, it's what we refer to as the AGR issue, the adjusted gross revenue definition that went through the India court system. That placed a pretty heavy burden in terms of taxes, penalties, and interest on Voda Idea specifically, but also Airtel and some other landline carriers that aren't in the wireless space. So that's created a little bit of financial pressure, particularly on Voda. So we're watching that. That has driven Voda, I think, to churn probably more sites than we expected them to churn in 2020, and I think that's going to continue into 2021. A couple of things to note there. One is the government did extend the time frame of those required payments out over 10 years. So that gives Voda a much longer runway to set their balance sheet and to kind of chart their course going forward, both from a strategic standpoint as well as the capital structuring and cash flow wise, putting themselves in a position to handle all these government fees that are coming their way. The other thing I would say on that is that Voda and Airtel and others have gotten together and they continue to petition the government to rethink the calculation of those fees. And they've asked a few times and the government has said, no, they're not going to revisit that. They're now willing to revisit that. So there is work being done in India with the carriers and the government to review the calculations and try to figure out if they've actually settled on the right amount or if there is an error in the calculation. So there's some hope there that maybe the overall fees and penalties will come down potentially. The other thing we're looking for is Voda Idea is out in the market looking to raise either a combination of debt or equity or one or the other. And we expect that to conclude at some point here soon, where every indication is that they're going to be successful in raising $2 to $3 billion in the near term. That will certainly help shore up, their capital structure and their operating plan, and that could have a direct effect in terms of reducing the overall churn potentially. So we're looking forward to that. The other thing is, in 2020, the industry did raise tariffs in India, so there's a more healthy kind of economic outlook for all the carriers where pricing is coming back up to a more reasonable place. It's driving more EBITDA and cash flow for all of the carriers. We think there's another leg of that to happen where pricing can go up again for the subscribers. We don't believe that the pricing is yet at where the market would suggest it should be. And there's a lot of talk in India about the carriers, being prepared and ready to increase those rates. When that happens, that'll introduce again, an uplift in EBITDA for all the carriers, including Vodafone. So, that's kind of three things that we're looking for. And when those things begin to happen, we do think the outlook becomes much clearer and much better for India and for us in India going forward. In 2021 specifically, we're projecting roughly 0% organic tenant billings growth. It's important to point out that there's two pieces to that. One is we see high single digit, almost double digit kind of gross growth there. So there is a lot of activity, primarily from RGO and Airtel in the marketplace. But unfortunately, that's offset by higher levels of churn than we would like to see and that we expected to see. So we do see a path that once the churn begins to subside further from its current level, that we can then return to historically normal levels of overall tenant billings growth in India, which we view that as being high single-digit organic tenant billings growth. In our outlook, we've taken a conservative view. So even over the next several years, in our outlook, we've got that kind of rising back up to the mid-single-digit growth rates. And again, I would stress
2027, yeah.
Yeah, that kind of a time frame, at least in the first several years of that, Matt, we have pretty conservative outlook there in India. So I don't want to leave the impression that that's what we think the India market holds for us is mid-single digit. We don't. We think it's going to be, it has the ability to get back to that single digit, high single digit, maybe double digit organic tenant billings growth once that churn comes down. The issue is it's really hard to predict when that churn will come down because some of the factors that will drive that and allow that to happen will, are outside of our control and maybe even outside of the control of Voda, where the government, kind of weighing in. And the final thing I would say about India is when the government has talked a lot about a 3-carrier, market being preferred. They've talked a lot about their strategy for the country around digital India, which is trying to make sure the economy and the people within the economy are all on an electronic platform for banking and commerce and other things like that. And in India, the only way that happens is if you have a robust very healthy wireless, industry. So it is important to the government to help the industry. And I do think that there is hope there on behalf of the carriers that the government will set some policies and take some steps to support the wireless industry, because it is central to their Digital India initiative being successful over the long term. So we think India is in a great place to drive long-term growth and value creation. And we certainly have gotten through the most difficult part, which was that rapid consolidation of more than 10 carriers consolidating down to just 3 in the course of a couple of years.
Yeah.
I guess with
Okay.
that, you want me to pivot to in the inflation piece, or?
Yeah, no, that's great color. And I just make a comment that it sounds like there's potential upside. You've described the AFFO CAGR as an aspirational double-digit CAGR. It sounds like there's a level of conservatism there in India, which would allow for potentially, some flexibility to meet that double-digit CAGR.
Yeah.
Given the level of conservatism he has in India. Before you move to inflation, just there's a couple questions that came in early, I think because the screen was frozen. So I think I know the answer to this one, but I'll let you answer it. I think when you were talking about the projected double-digit AFFO growth rate through 2027, I guess the screen froze. So can you just restate what you had said before on that? And then there's a couple other questions, but that should be perfect.
Yeah, absolutely. So we did reaffirm our projections, our goal to achieve double-digit AFFO, consolidated AFFO per share growth on average from 2021 out to 2027. And there's a couple of pieces there that I would highlight. One is, we think this is a very realistic goal. It's an achievable goal. It's more than we talk about it at times, Matt, as an aspirational goal. It's a goal of management to drive double-digit AFFO, consolidated AFFO per share. It's a real goal. So to the extent that anyone thinks by putting the word aspirational softens our commitment to trying to drive that, it doesn't. It's a real goal for us to drive that, and we think it's achievable. But one of the things I did point out is that it's on average. So it doesn't mean we're going to achieve that every year of the 7 years. Particularly in 2022 could be a challenging year to get there with the Sprint churn. That's going to be the place where the majority of the Sprint churn kind of affects our numbers on an in-year basis. And then a couple of other points that I made, I did highlight the fact that a big driver of that double-digit AFFO growth is going to be the organic tenant billings growth number in the US that we talked about. And 2/3 of that is committed contractually. And the pieces that aren't would be carriers that wouldn't be under a holistic deal, out through that entire time frame, and any additional lease up that we expect from them. And there are some that given the way we sit now, won't be under a holistic deal under that whole time frame. So any activity, any new incremental gross adds would be in the 1/3 that's not committed. That would include some of the C-band spectrum deployments, and it would also include some activity from Dish. It could also include some activity from platform extensions, like the in-building things that we're working on, the edge compute, and maybe some others. So in that, double-digit FFO, we have modest views around platform extension, and we have modest views around new entrants into the wireless space. And we have some assumptions in there for Dish because we do see them preparing to build. But to the extent that they build out a 50,000 network and they build out a very competitive 5G network nationwide, that could represent upside, certainly to the AFFO outlook that we talked about.
Great.
A couple of things I would point out on inflation. We have businesses, certainly in the US and around the globe, India, throughout Latin America, Africa, and in Europe. And there are some differences in the way that we are set up in terms of escalators and the way that inflation may or may not impact us. So in the US, we do have a standard kind of 3% escalator. We've had that for years. That's been well above the rate of inflation. Inflation to head. So fairly well insulated from that perspective. when you think about the international markets, that's where inflation can be much more impactful and more meaningful.
Right.
And in most places around the world, our contracts, by and large, are set up with local CPI inflation rates. So throughout Latin America and Africa, and even into Europe, it's very similar. So from that perspective, we're insulated from inflation rates as well. As inflation goes up, our revenues kind of go up correspondingly, and so we're fairly well insulated from that perspective as well. So we think we're in a pretty good position here in terms of the growth rates. And then I would say in terms of the makeup of our revenues and organic tenant billings over time, we have seen a few changes in the escalators. So in throughout Latin America and Mexico and Brazil, those escalators have come down maybe 100 basis points or so in 2020, let's say, from the 2019 levels. So we have seen a little bit of a softening there, and you see that kind of run through our numbers. To the extent that inflation begins to go the other way, we could see a little upturn in terms of organic tenant billings growth, to the extent the escalators come back up. So in a place like Latin America, where we're looking at 3% growth rates in the U.S. from an escalator standpoint, when you look at Latin America, it might be more like 4, and even 5 now in some markets. There are some escalators in Brazil that are quite high. And then the other thing that I would say in terms of the international markets, particularly in, let's say, Latin America, is we do have some levels of elevated churn that's still working through those businesses as well, particularly in Brazil and in Mexico, where I think everyone knows we have Oi in Brazil, where that's changing hands. We also have some consolidation of Nextel being bought down there. We've got some activity with Telefonica in Mexico and a few other places. So we have seen a little bit of an uptick in churn. At the same time, we've seen kind of a bump up in the escalator as well, which kind of offset one another. So I would say that oh, go ahead, Matt.
No, I was just gonna say, just to round out the question, I guess the question is, through 2027, is the general view that inflation in the various markets will increase? You kind of assume that it's flattish to where it is today. How do you kind of think, and how sophisticated are you on modeling just the inflationary aspect of the lease?
We don't make a lot of assumptions around forward-looking inflations when it comes to revenue. So we're not assuming a big jump up in inflation or CPI or escalators in order to drive that revenue. The only place where inflation rates come in is we model out some things to try to predict where FX may go, and we compare inflation rates around the globe to the US inflation rates, but not really to make revenue assumptions in the local market. So that we don't have any material escalations, or really much in terms of inflationary escalations on our revenue kind of in that long-term outlook.
Got it. Okay. Maybe moving on then, you mentioned Telxius in your opening remarks, and maybe we can just touch upon that deal for a minute. Can you elaborate on why you think that deal made good sense for AMT, and perhaps what is unique about that particular portfolio versus other European tower portfolios that have come to market? Having followed the industry for a while now, I know that management's previous view was more cautious on Europe due to the slower growth. So is it that the European market has changed, or is it something specific about the Telxius assets that you guys found attractive?
Yeah, it's a great question, and it's absolutely the latter. It's that we look at the Telxius transaction and we see that being a very attractive portfolio for us. So, and then to address the first part, our views on Europe have not changed. So the way that we looked and evaluated deals over the last several years is the same way that we looked and evaluated the Telxius deal as well. We just ended up with a different outcome in a much more favorable view. And that was because of the specific assets and the countries in which those assets reside. So a lot of times people, I think, make the mistake as thinking Europe is all the same. All the countries in Europe are the same, and we don't view it that way. We don't view Europe as just a a collection of very similar countries, we look at each country very differently. They all have different regulatory schemes. They have different carrier construct and different industry makeup. And so we analyze all that. So our outlook, our view on Europe has not changed at all. This asset in particular is very attractive to us. Number one, it's a counterparty with Telefonica, who we have a good relationship with in Latin America and in Europe today. We've done a few transactions with them in Latin America. So we think them as a counterparty in Europe particularly is really good because they're strong in Spain, of course, their home market, and really strong in Germany. So it puts us in a lead role right away in those two markets with a premier, carrier in both of those markets. That's good. They make up most of the revenue as the leaseback partner. So the churn on that portfolio is going to be very low. Like there's no other way around it with the contracts we have and the fact that Telefonica makes up most of the revenues. There just won't be much churn on that at all. That's much different than what we've seen in a lot of other portfolios, as well as what we've seen in some of the countries across Europe. Churn rates have been fairly high. So that's a big driver of organic growth. That leads me to the next point, which is on this portfolio specifically, and in Europe specifically, we see very attractive levels of organic tenant billings growth. We think that in Europe, on this asset, we can grow 5 to 6% organic tenant billings growth over the next several years. And that's led in Germany, probably up in the solid kind of 6 range. So we do think the assets, the counterparty, the locations, and the country is really good. That it's a 31,000 site portfolio with almost 12,500 of those sites in Germany. And that to us is the premier market there that we kind of anchor on. We're already in Germany, so we've liked Germany for many years, and we've got a portfolio there. And we're actually seeing our gross organic growth rates in Germany rise. We saw that through 2020. We're projecting that in 2021. One of the things that I'll note is in our existing portfolio, even though we're seeing an increase or an acceleration in the top line organic tenant billings, the gross organic tenant billings growth, we are still seeing elevated churn because of the makeup of the legacy portfolio. So with the Telxius portfolio, we'll see that acceleration in gross growth, but we won't see the above average churn for the next year or two. So that's what makes that portfolio very attractive. That's where we see the value creation. And then, of course, in terms of the way we can manage the balance sheet and finance that transaction, that's pretty exciting for us as well. Bringing in more euro-denominated assets, more euro-denominated cash flows, give us the ability certainly to finance, part of this transaction with euros, but also have euros being maybe a bigger part of our overall capital structure over the next several years, and have more diversity and more size available to us as we bounce back from the US markets and the euro markets, and be able to plan our balance sheet and our overall cost of debt in a way that gives us more options.
Right. Maybe, yeah, so that's great color. I mean, maybe 2 follow-ups to what you've mentioned. I mean, you've talked about the German opportunity specifically, a couple of times. Just in terms of that particular market, I think, most who follow towers know that Vantage Towers, the Vodafone assets, a number of the Vodafone assets in Europe are set to IPO here imminently. And they have a large presence in Germany as well. How do you think that potentially impacts the competitive dynamic in terms of ability to bring on co-location in Germany versus perhaps previously? Do you think that's going to change a lot, or do you think there's ample opportunity for 2 large players to kind of play in that market? And then I also have a question on you mentioned the financing side and getting a partner for the Telxius deal. Maybe I'll ask that next.
Yeah. Okay. Yeah. Great. So I think with the German market and a potential IPO of Vantage Towers, that doesn't change our outlook for that market. It certainly doesn't change our projections around what we think we're going to be able to drive in terms of organic growth. It's not a new phenomena for us to be in a market where you have a quasi-captive tower company with wireless carriers as the owners. We've seen that in India and other places around the world. We even saw that in the US for many, many years. So we've operated successfully in a number of markets, both developing markets as well as developed markets, where the carriers owned significant portfolios and made those available for leasing. And we've been very successful in those markets. So we're not worried about that. We think the neutral host model, the independent tower company, is an attractive option for people entering the market or for the other carriers when they look for sites. So we think we'll do just fine, and we're not worried about that process. The other thing I would say is, in most of the other places around the world where we've seen that type of an approach, eventually those towers end up in a different place, in more of a neutrally hosted model. That's where, in my view, that's where the towers can attract the maximum economics, when they're truly neutrally hosted. We saw that in the US, eventually they get sold. We saw it in India, eventually they get sold and turn more into a neutral host model. So we've seen that kind of happen around, around the globe.
Okay. And then before I get to the financing, I guess, you were talking about the growth rates in Germany and focusing on that. Are there any other markets from a country perspective in Europe, aside from Spain and Germany, that you feel like, currently the fundamentals are strong enough that you might actually continue to add to your European tower portfolio, on an inorganic basis, potentially?
Yeah. Yeah. So first off, we're building a lot of towers in France with Orange as the counterparty, and as part of the Telxius deal, we also have the opportunity to build a couple thousand towers in Europe for Telefonica as part of the Telxius transaction. So we'll continue to invest, capital into the Europe market, and we're excited about that. This Telxius deal really is transformational for us in Europe specifically. So we don't feel the need where we have to do another deal to become relevant. This deal puts us on the map in the key markets that we're in, and certainly adding to that with the build-to-suits and the relationship we have with Orange and Telefonica and others, we're in a really good position. With that said, we will continue to look at any and all towers that come to market in Europe, and there are other countries that we would, look to expand into. There's also expansion possible in the countries that we're already in. And we'll continue to be very disciplined. We'll continue to kind of look at it in the same way we always have. So you won't see us, begin to execute on every deal that comes up. We're going to continue to be very selective and look at the deals that come up. And if one comes up that meets our criteria, that meets our risk-adjusted hurdle rates, that gives us the right counterparty and the right risk profile overall, absolutely, we would be interested in investing more in Europe.
Great. Yeah, so you mentioned hurdle rates, so let's talk about the financing side of Telxius for a minute, and kind of translate that back to what large institutional investing partners want for a tower portfolio in terms of longer term levered IRRs.
Yeah.
I mean, I guess, you're alluding to your original assets in Germany. I think that deal, if I recall correctly, was a little bit different in that you went in with the partner. And so this is a bit different, where you've acquired with Telxius, you've acquired the assets and then are essentially offloading a piece of the European business to a partner. But so two related questions. One, what do you think, with interest rates declining, with the appetite for towers increasing, where do you think hurdle rates or required returns are on the institutional side, the institutional investing side, for tower portfolios? And then, to the extent that you do end up using this platform for future acquisitions, presumably the hurdle rates for your partners are lower than your hurdle rates. As the industrial player, how do you actually structure the nature of the entity that you're acquiring and building with in order to achieve your returns and still provide the type of return profile you need versus what's presumably a lower, more preferred return for an institutional investor?
Yeah, it's a great question. A lot of detail there, and not that I want to avoid too much of the question. I'll answer as much as I can, but we are kind of actively in the midst of putting together a financing plan. I don't want to talk too much about what I think the potential investors will be looking for and those sorts of things. But what I would say is that, the transaction that we're doing in Europe, it's a $9.5 billion purchase price with some follow-on capital in terms of build to suits throughout the region. And we will finance part of that, part of that purchase price with a temporary elevation in our leverage. So we're going to bring leverage up to the high 5 times. That could be up there for a few years, a couple of years. We will begin to delever after we complete the Telxius transaction. So that covers a good chunk of the purchase price, certainly. And then the remainder of the purchase price, our options there are to, fill it with equity. And we want to make sure that we balance that and look at all the different types of equity options that we have available to us. Private capital is one of those options. Mandatory converts is also a potential option, and outright common equity issuance is an option. So the way that we view that, Matt, is the way we view everything, right? We want to make sure we have access to as many sources of capital as possible, that we're evaluating and understanding the current economics and other governance type terms and conditions that come with any of these capital options. And we want to evaluate that and make the best decision on behalf of our shareholders. That's kind of the way we think about it. And we think in the current market and circumstances, and always we look to minimize common shareholder dilution. That's important to us. That's kind of been in our DNA for a long time, and it continues to be there. When it comes to the Telxius transaction, we're dealing with and working with a few very strong strategic partners that, quite frankly, bring a lot more to the table than just capital. They have relationships within the marketplace. They understand the marketplace. They in many cases, some of them have other types of infrastructure deals within the region, by and large. So, we do think that there's more than just capital, coming to bear here in this decision. There's also the strategic elements of having a strong partner in the region. We think that could be helpful. With that said, we'll be balancing kind of the cost of the private capital up against cost of the public equity. And there will be a balance there. And we don't, we're certainly not expecting to bring in a higher cost of capital, right? The whole point here is to bring in lower cost of capital, right, expand options, and have a partner. And that's where we're trending. And I think that looks really, really good for us. So we do think that we have and we've been working at this for a while. We're in very, productive and fruitful conversations with a number of large global investors with lots of capital to bring to bear. And we're at a point where the discussions are serious and we have credible options there. And then we will be balancing that, of course, with common equity and mandatory converts and putting together the whole package that will help us, close this transaction in a way that's most efficient and drives the most AFFO accretion and long-term value creation for our shareholders. That's really what our focus is.
Yeah. Okay. I understand. Yeah, it's great color. Just in the interest of time, I have several follow-ups to that, but in the interest of time, I do want to get to the questions that were posted, by the audience, and then we can come back and continue along with the questions that I had prepared. Okay. So first question is from Liz O'Leary. Her question is, do you see 5G adoption hindered or hastened by a slower economy post-COVID? And what solutions do you see as feasible or likely?
It's a great question. And I guess I would lean towards the side that I don't see 5G being slowed because of any kind of an economic disruption in the US. That's not what we've seen before. So we saw probably the biggest investment in kind of launch of 4G was being developed during the 2008-2009 financial crisis. And the carriers didn't slow down through that crisis at all. So, that really kind of showed and proved that the development of these networks and the transition from 1G to the next is not necessarily tied to the local and current economic cycle, but it's more a whole technology platform. They need to invest now to have their networks be able to handle the traffic 2 or 3 years down the line. So they don't have the luxury to just stop building because there's a short-term, economic downturn in the US and then start building when that goes away. So we don't expect that to be the case. And I think, another point that I would make is based on the results of the C-band auction and the significant prices paid, it doesn't seem as though the carriers are really concerned about the economy and that they're focused more on getting the spectrum they need and deploying 5G in what is a very competitive US marketplace now with AT&T, Verizon, and T-Mobile all vying for, let's say, to be that number one 5G player here over the next 5 to 10 years. So I don't think they have the luxury of just stopping and starting like that. I don't think that their investment certainly into the C-band auction would tell me that they're ready to go with 5G deployments. They want to get the assets in place that they need. Part of those assets is spectrum. The other part is getting the network built out to handle that spectrum. So we do expect to see them deploy C-band later this year. And that deployment and investments in 5G will then span the next 10 years or more. It's a long-term investment cycle. And again, it's not driven by short-term economic cycles. That could be a little, we see a little bit of difference there, and I'll just use some of the international markets. It's not a 5G context, but in the international markets, you see a little bit more reaction to short-term economic cycles than you certainly do in the US. And I don't think you'll see that in Europe. I think Europe will be much more like the US.
Yeah, and I know, just for Liz, if she's not familiar, I know you guys have in some of your investor relations presentations kind of showing the duration of the development and then usage of the different generations of wireless. And as you said, it spans, many multiple years. So, the planning cycles need to be as long as
Right.
as those usage cases, which, as you said, tend to be 10 to 20 years. So,
yeah.
Maybe one other question that I want to get in here before the hour is up is, the question is from an anonymous attendee, but the question is, on the international side, what is the opportunity in Southeast Asia? It seems to be one area lacking from the AMT portfolio, any big market for data. And so maybe I'll just add on to that question. Obviously, there are the likes of the Protolindos and the Bersamas of the world that do have a presence there and do have historical ties to American Tower. Maybe just talk about why you haven't entered that market, given the knowledge of that market, as well as the fact that there is a large overall opportunity set there and other players playing.
Yeah, absolutely. I think there is a big opportunity. Certainly in Southeast Asia and in that general region there. And the first thing I would say is we've been looking around the globe, and that includes lots of parts of Asia that aren't India. So we've been doing an awful lot of work there. The only reason you haven't seen us do any significant deals outside of India is because we just haven't bumped up against the right opportunity with the right values and pricing and the right time. And it just they haven't met our disciplined kind of criteria and the way we allocate capital. But we continue to look just the same way in Europe. We're patient. We look at everything. We work on every deal like we're going to do it. So there's a full, there's a full amount of energy kind of put into all these potential deals, and that includes Asia. So I think when and if we find the right deal with the right counterparty in the right country with the right value terms and conditions, certainly you could see us expand in the Asia region without a doubt. And that goes for Europe and it goes for Africa, as well. You can see us continue to expand there. As part of this is just a side note, but as part of the Insight deal, we did end up picking up several hundred parcels of land under towers in Australia. So we do have a presence now down in Australia. It's a very small presence, but we do have that.
Yeah, great. Just in the interest of time, maybe I'll maybe I'll touch on something that's topical these days and skip over. I think Fraser, if he wants to jump in here, he'll tell us if we have a hard stop at the hour. But maybe let's just chat about ESG for a minute. It's something that's topical, across the board for all asset classes these days. And maybe you can just elaborate for the group, on American Tower's ESG priorities. I mean, I know recently you've talked about on the kind of E side, solar installations at the sites, and some, use of renewables to kind of, accommodate or improve your environmental footprint, as well as potentially lower the cost of power, heading to the site. But perhaps in addition to that, what are the other ESG kind of initiatives? And I know, here at Morgan Stanley, one of the common questions is, well, how are ESG matters tied up through to management compensation? Are they, or are they not? Where does the ESG team report? Do they report to the board and to you, the C-suite, or do they report to somebody else?
Yeah. It's a great question. Happy to address that. So a couple of things. Number one is the whole topic of ESG is a priority for American Tower, right to the full executive team, including the chief executive officer, Tom Bartlett, as well as the board. So lots of discussions around the topics, that make up the ESG. Our priorities here are I guess I would put them in probably three categories. Number one is reducing our carbon footprint, reducing the usage of fossil fuels. That is a big issue for us and for our customers, particularly in India and in Africa, where a lot of the assets are off grid and rely on diesel fuel. So we've invested heavily into lithium ion batteries, and we've reduced our diesel fuel consumption across Africa and in India pretty substantially. The next one is we've got what we refer to as digital villages, where we contribute computers and electronics and places for local villagers in Africa and in India to go where they can access the internet for educational tools, for banking tools, and different things like that. And those that we have a huge response when we deploy those, and we've deployed dozens of them. And you have lines of people, waiting to get in and to use their electronics. We pay for those, we maintain them, we're partnering with other people in the region, and that's going really well. And then we also, diversity and inclusion is a big issue. Racial injustice is a big issue within the company. So certainly a lot of discussions at the board level with the CEO and the executive team to make sure that we do more and do better, and make sure that that's an issue that we focus on.